Hey, this is Joanne with Broadcast Sunny, and today is Financial Fridays, and today I'm going to show you how you can stay in debt forever with your credit cards, and then I'll show you how not to. So now I'm going to show you how you can stay in debt forever with your credit card company, even when you do everything right. The numbers that I'm going to use today are numbers I had taken from my own credit card statement, but I rounded them to make it easier to understand. So let's pretend that you bought a computer and it was worth $3,000, and the $3,000 become the balance on your credit card. You're not going to buy anything else until you pay this off. So this becomes your debt, and you have a minimum payment that the bank says you have to pay in order to avoid a penalty, and that's $30. The $30 is 10% of $3,000, and it's not even going to cover the 18% interest that you're going to accumulate for the next month. So you end up adding to your balance because this is why you're never going to pay off your laptop. You're not paying off the balance, you're adding to the balance because 10 is less than 18. I think that's pretty sneaky of them. So try to remember to think of credit cards as very high personal interest loans. The banks are not in the credit card business to not make money. They're in it to make money, and that's why they make the minimum payment lower than your interest rate. They want to know that you can continue to keep paying. However, if they can rack up interest and make that balance bigger and make you pay forever, that's more money in their pocket. Ideally, you want to try to pay off the entire bill at the end of the month. That way you're not getting any penalties nor paying any interest. However, I also understand that is not always possible. So your goal is to pay more than the minimum payment. Actually, your goal is to pay more than the interest rate. And in this scenario, I have it down that you're making a minimum payment of $60 a month. That's 20% of the original remaining balance. The interest rate is 18%. This is 20%, so it's a little bit more than the interest rate. Keep in mind two things. One, this is not calculated by your credit card company. You'll have to calculate it yourself. And two, the $60 need to be paid month to month. That 20% is according to the original remaining balance. You should see your balance reduce each month. However, you want to keep paying that $60 so that you can reach this wonderful time period of 7 years and 10 months to pay off that $3,000. Not only that, you end up paying over $2,500 in total interest, and that $3,000 computer ends up costing you over $5,500. And after 7 years and 10 months, I don't think that computer is worth $3,000, much less $5,500. However, you are paying off that computer, which is a nice thing, and not staying in debt forever. And this is a great debt calculator. I recommend you checking it out. I'll have a link to it in the description, but it is through calculator.net. For those of you who want a little help with the math, it's quite simple calculating the minimum payment. You're going to take the balance, and then for our scenario, we did 20%, so 0.2, and that's where I got the $600. Of course, you can pay more than the 20%. You can maybe do 25. Keep doing that. The 25%, or maybe 30%, and that's what you should pay each month or more. But remember, always do more than your interest rate. And your interest rate might be more than the 18% I did in this scenario. Anyway, that is calculating your minimum payment.